Well, it's that time again. Another month has gone by. Cathie Wood has done her level best to explain what's going on in the economy and what she thinks is going to happen in the future economy. And we're going to look at that. And then at the end of looking at what Cathie says, we're going to take a look at what we think that means for Tesla going forward into 2024. And to help me do all that, as usual, it's Larry Goldberg. Good morning, Larry.
Good morning, Randy. How are you this morning?
I did very, very, very good, Larry. I don't know about over there in North Carolina. Here, it's supposed to be like 75 today. So it's,
Another lousy day in paradise. Today, we just have a lousy day. It's pretty cold. No, I shouldn't complain. It's not bad.
No, North Carolina.
Yeah, it's not bad.
Yeah.
So Cathie, she came across with the usual preciseness, and she's been amazingly accurate over the years in terms of her economic prognostications, and I don't think it's different now. And it has a lot of implications for Tesla's future, which I guess we can say is a very bright future. But the point that Cathie makes in all that she tells us about the economy is that innovation matters.
Right.
And it's all about innovation to get us out of what could be a very nasty scrape. And so, I think that what we have to look at is the whole story to get a sense of everything that's going on. And then we can sort of look at it at the end and say, what's this all about? How does this impact us?
Right.
But
go ahead.
Go ahead.
She opened her gambit by saying that she expects a weakening in the economy and inflation. And I think that's pretty much across the board. Everybody kind of agrees that we can't maintain 5% GDP growth. So I looked it up. The Fed is expecting around 1.2%. I think she says that later in the fourth quarter. And then maybe that could be the first quarter as well, around 1.2. But overall, that's her major thesis, is that we will have slowing inflation and slowing economy. And then she makes her case.
So, Randy, riddle me this. With the 1.2% inflation, what should the
1.2% GDP growth.
1.2% GDP growth.
Right.
With a 1.2% GDP growth in real terms, and inflation down to the 3% range and falling, and the money supply collapsing, or the money supply of velocity remaining extremely low and money supply in real terms collapsing, what do you think the Fed should do?
I think you know what I think. I think the Fed should lower rates in January. I still think they'll do it in March. And I think that we'll see the market and the economist survey both switch back to March after we get the numbers on Tuesday and Wednesday this week.
And I think they should relax interest rates in October 23.
Yes, right. Well, and as you and I talk about all the time, the other thing they need to do is stop selling bonds. They need to just stop. I don't care if they buy any. I just like to see them stop selling bonds because that is, of course, a bigger impact on the money supply.
Have to stop selling bonds when you got that kind of pile of it. Janet Yellen took a victory lap yesterday. Now, she is so blind that not only did she bring us into this mess, but she doesn't even understand the mess she's in.
Yes. Well, yeah. Well, we've been saying that all along, and nothing has changed on that one.
Except she took a victory lap.
Victory lap. Yeah, no, it's funny.
And so, it's just amazing to me. It's just amazing to me. So,
well, Larry, I want to take a victory lap, because one of the other things that she said, one of the other things that Cathie said this morning, is she now believes that inflation was transitory after all.
yes.
And that's what I've been saying. In the beginning, when they said inflation was transitory, I said, yes, it's transitory, but it's not going to be in a few months that it's going to transition. And then after they said, oh, I guess it wasn't transitory after all, I said, yes, it was. It's just going to take longer. So now Cathie has come around to believing it was transitory. It was a boom bust situation. Because I was in the bicycle industry for 50 some years, I've seen this boom bust story over and over again, because bicycles are really, really, the oil prices go up. People say, oh, I got to have a bike. And then the oil prices come down and everybody that bought one has one. I mean, everybody that wants one has one. So I've seen this over and over again. So I had kind of a special knowledge of what these things look like. But yeah, it was transitory. It just took longer to play out than we expected it.
Yeah. Yeah. All right. So let's revert. Let's take ourselves through, take a journey through everything Cathie's taught us today, or
Yes.
shown us today. And then, we can circle back and understand what this means for the Tesla investor and for the future of Tesla. Does that make sense?
Perfect. Well, you want to throw up your slideshow?
Sure. So let's share the screen. Everybody can see. Yeah, I'll show the whole screen. Why not? Tell me when you see the screen.
You're perfect. We've got it.
Okay. So we start, of course, with the federal budget, a deficit or surplus. And, if you look at the deficit, it's very high by historical standards. As a percentage of GDP, it of course got to some incredibly ridiculous levels in the pandemic, but we knew that.
Larry, people should realize that this is the negatives are at the bottom. So
yes.
So
this is the deficit.
It kind of looks the opposite of how we normally think. So the deficit, meaning negative, is the higher the deficit, the more it goes to the bottom of the chart.
Yeah, you'd have to go back to the 2010s to see a deficit anything like we've been through. We, of course, plumbed much further depths. We're still pretty low because, if you look at the historic situation, absent this, we're not in a good position. So we don't have any wiggle room, even though we're going into an election year. The Republican House is going to keep the lid on for sure in terms of expenditure.
So Cathie thought that they might even do more than keep the lid on. I was shocked by that. I would be, given that the Republicans don't have enough votes, but she thought maybe Republicans might be able to pick up a few Democrats and do some cutting into the federal largesse. What do you think about that?
I think that's a bridge too far.
Me too.
I haven't seen a Congress really cut. I mean, Reagan came in on the ticket of cutting the deficit.
Right.
And even Reagan was unable to do it. So
only Gingrich was the only one who really was able to cut.
And that was transitory. That didn't last very long.
Yep, did not.
So yeah, and the most important slide, as you know, is the money supply. So while the Fed has been going on and on about inflation, and Cathie's been pointing out that it's transitory, nothing speaks to this problem more than this slide. Money supply has fallen through the floor. And inflation is a function not only, of actual expenditure, but it's also the velocity of expenditure.
Right.
So even, if you've got, huge amounts of money being pumped into the economy, nothing's going to happen unless that money is spent.
Right.
And this is the measure of money being spent, of the rate at which money is spent, not money being spent, but the rate at which
Right.
the
Right.
money that is in the supply is being spent. And it's at, it's just bounced very slightly off an all-time bottom.
Right.
But I mean, an all-time bottom. I think we probably would see something like this in the 30s.
Yeah.
So this whole inflation thing has been a ruse. I mean, not a ruse. It's just a misunderstanding. It's just the Fed, in their wisdom, have not been wise.
Right.
That's my view. So, I think it's pretty serious, and I think so. We've seen real shrinkage. The base has dropped from what Cathie tells us. The base has dropped from 8.5 trillion at the peak to down to 7.7 trillion.
Right.
So that's a real shrinkage in real terms. So
right.
It's pretty serious, and I think that it's the reason why we shouldn't be being so focused on the. I'm not even showing the velocity. I should be showing the velocity. I'm sorry. So the velocity has, again, it's shrunk. I mean, it reached a very, very serious point at the bottom, but it's still down below historic levels, even though it's up a little bit.
Right. Right.
So then we get to your favorite slide, and that is the yield curve. And it's still negative, although it is improving a little bit.
Right.
But I think your point on this slide is very clear. And, I don't know if you need repeating it, but quite clearly we should be, it's time, for the Fed to actually
help this to reinvert. So some people point out, you'll notice on this is that the recessions happen after the yield curve starts to reinvert.
Yeah.
So it's not while it's going down, it's after it starts to reinvert. So because again, the markets are supposed to be predictive. And so now we have that reinversion taking place. But it's a very, very, very weird overall situation this time. It's stayed this way for a super, super long time. And I'm still I still believe that there's at least a chance that we're seeing something foundational, something fundamental changing in the economy because of the aging of the population. And, we'll see what happens over the next little bit. But I've also stated recently, Larry, over and over again, that I think there's a real big bull coming in the short-term yields. I think that's going to be the next bull market, if you will, like the 10-year rush that we had over the last 60 days. We're now going to see the 2 months and the 1 year and the 2 year, all of those, there's going to be a big move in a positive way for the underlying asset, negative on the yields.
My thesis of, every recession is different.
Yes.
Like unhappy families. But if you look back at recessions in the past, you'll see that the pattern varies in terms of when the recession happens in relation to the inversion.
Right.
When there's an inversion, there's invariably a recession. When we look back in the future, I think we will understand that all of this period has been recessionary.
Oh, I see.
Certainly this period here has been recessionary. They changed the rules about what a recession was in order to get out of the last recession. I think we're still in that recession, and I think we're, Cathie calls it a rolling recession. I think it's a real recession, and she picks up areas of the economy that are in recession. So time will tell, but
Right.
I believe we are. And this is, to your point, the federal funds rate in the future. This is what we're looking at in terms of what the market is predicting. I think you're predicting a little bit more aggressive reduction than the market is predicting.
Well, there's a range now, Larry. There's a range of people saying it's going to drop 0.75 or 75 basis points next year, up to some people are predicting as high as 125 and higher.
Well, here's the range, really.
Yeah.
3.5 to 4 is what they're saying.
Yeah.
Down from 5.25.
5.5. Right.
So that's a big range. Well, that gets to 2025. If you just look at 2024.
Oh, yeah.
Range is not so high.
Right. Yeah, but there. I've seen headlines. I've seen pundits, at least. I don't know if these are economists, but some of the pundits are calling for his, 1.25 during the course of the year. And most, I know it's only about 50% now, but it's right at 50%. I think it'll be March will be the first one.
I'm predicting that everybody's wrong. I'm
Okay.
predicting that we're going to see massive moves. You see these moves here?
Yep.
Half points at a time.
Yep.
I think we're going to see as massive moves down as we've seen up.
Wow.
And it's going to be later in the year than early in the year, because I think they're going to start by saying, oh, we'll take a measured move down. Janet Yellen took her victory lap and everything's fine. We'll just take it a little bit down. And then when they realize the damage that has been done, they'll be boom.
I see.
It's exactly like this is, when the Federal Reserve governor, the chairman woke up and thought, oh my God, it's not transitory. Boom, boom. And now when they realize, oh my God, it was transitory. Boom, boom. That's just the nature of this beast, I think.
Yes.
I could be wrong. So here are the real GDP growth estimates. Bloomberg has been very, very, very pessimistic.
Right.
But this is GDP now. That's this consensus estimate.
Mm-hmm.
And they're all, talking down at the 1% level, real GDP growth levels.
Right.
Which are not recessionary levels, which, really undercut my thesis. But I believe that the real GDP will not be at the 1% mark. I think it's going to be below the 1% mark. I think it could even turn negative.
Mm-hmm.
Not for fourth quarter, but certainly by next quarter.
Okay. All right.
All right. So I think I'd be interested. I can't recall what Cathie said in relation to the estimate.
I think she believes there will be a recession next year.
Yeah.
She's pretty clear that, it'll be a shallow one. I don't think she's expecting a big, deep recession, but she's talking about numbers like the temporary workers, but we'll get into that. I think she expects, at least 2 quarters next year to be negative.
Yeah. I mean, I've got such strong thoughts on this that I kind of didn't listen properly.
Okay.
This is the University of Michigan's Consumer Sentiment Index. It's kind of off the bottom, but not a long way off the bottom, right?
Right. Mm-hmm.
And so that's not a strong growth indicator.
No.
If you look at the previous recessions, you'll see that there's a strong correlation, as you know. This is the indicator that Cathie is most interested in terms of employment, far more so than the employment figures from the Bureau of Economics. And one of the most important things is the temporary help employment index, because it leads the employment index, and so the temporary help turned over around the end of 22, and it's on its way down, even though the non-farm payroll is going up. So I think this is a very, very early indication of the decline in employment.
So Larry, this is one of the ones where I was really a little sad about Cathie's not pulling back a little bit and thinking this through. What you see here is a spike in temporary employment. This, I've never, in my 60 years in business, I don't know about for you, but in my 60 years in business, I have never seen the shortage of labor that we had a year ago, 2 years ago, a year ago. I mean, literally, I've told this story before, but I saw a sign spinner, one of those sign spinner guys, out in front of a retail store, but it wasn't trying to get people in the store to buy stuff. It was they needed help. They needed employees. I had my own clients. I'm a marketing consultant. My clients are screaming to get somebody to show up for an interview. McDonald's paying $50 for people to just put in an application. Never seen anything like this in my life. So therefore, the temporary employment people, I mean, I was telling my clients, try to get somebody through temps. But the temps, they were out of people too. They didn't have enough either. So this spike, look at that. Look at the height of the use of temporary workers compared to any time back as far as this chart goes, before 2000. It's never been this crazy, never been that high. So once again, you're going to have this boom bust situation. So now the temporaries are coming down as the manufacturers and wholesalers and retailers have the right mix in their building right now and getting more effective at more, as I've said, more productive because they have the right staff now. They're happy with their staff levels.
You know what happens when you drop a rubber ball and it bounces?
Yes.
It bounces again, but it bounces a little bit lower.
Right.
Bounces again, it bounces a little lower. Bounces again, bounces a little lower. That's what happened to employment and temporary employment because the government dropped the rubber ball. What was the rubber ball? It was the shutdown.
Yes. And massive amounts of money into the system.
Gigantic amounts of money into the system. And that money is now being used up. And the temporary help was just people, taking a 3-day job or a 5-day job or taking a 2-hour because they didn't have to work full time. So we're seeing that coming to an end. So yeah, we saw the spike and we saw all of this happen, but that's what's happening to the economy. We've been on this, so-called growth in the economy, but that growth is simply the recovery, the bouncing ball from, this extreme recession we went through, this extreme shutdown we went through. And so all of this historical information should have some kind of disclaimer wrapped around it.
Right, indeed.
In terms of its behavior versus any other time in our history.
Absolutely, it should. You should have an asterisk.
Yeah, it should all be asterisk. So, we have to be a little measured about how we respond to these numbers. And I think your point is clear, Cathie's point is clear. And now the question is, how does this fit into the bouncing ball situation? And none of us really know.
No. And here's my thought, Larry, and I'm the optimist, but my thought is if productivity is increasing at the rate that it seems to be, and again, this would be another boom bust deal. Productivity went through the floor because of the difficulties of the last 3 years, and now productivity is coming back strong. Plus, we've got GPT, and we've got all these new health things that are going to improve productivity in the health world. All of this stuff is going to improve productivity, which improves wealth. And
Yep.
we already have wealth, untold wealth. There's nothing on this chart, nothing that Cathie's going to show today in terms of the wealth and the amount of money that's still in the hands of consumers right now is just amazing. So that you combine increasing productivity, lowering inflation, and all that wealth, and that is where we could avoid this recession unless the consumer is just nervous. Again, an older population is more likely to get nervous and say, I ain't going to spend. And we saw that in the credit card numbers last month.
And we see it in the velocity of money.
And we see it in the velocity of money. Exactly. Yep. So that could be something to really look at, would be the conservative nature of the consumer as an older group at this point.
Well, this is the next slide that Cathie shows us, which is, the expected inflation rate, University of Michigan's expected inflation rate. So here is an analysis where, you've got this green, you've got let me see, we have the green line, services. Is it services in the purple line? Right.
Yes.
And these are University of Michigan expected change in prices.
Oh, I'm sorry. It's the long-term versus short-term, Larry. It's the green.
You're right. Long-term versus
green is the
short-term.
long-term, and the purple is the short-term.
Right. So,
so the consumer expectation has been that the short-term inflation was going to be high. They've been correct, of course, about that, but the long-term hasn't changed. It's been around 3% since 1995. It dropped a little bit over the 15 to 2022 period, but it's just back to the norm. And now the short term is also dropping back towards the norm as well.
I can't make out in the slide whether, it is dropping.
It's dropping back.
I couldn't make out that dropping. Yeah. It is dropping.
So the consumer believes it's going to be 3% next year, and it believes it's going to be 3% 5 years from now. So that's interesting that it's reverted to the norm. But you can also see how the consumer during the 15 to 22 period, the consumer never really picked up on the fact that inflation was at zero. Even though the Fed was screaming, we can't get it back to 2, the consumer still thought it was above 2.
Yep, which is an interesting thing. That's worth a drill down in itself.
Yeah.
But it's also interesting that we saw a tremendous increase in the costs in the Tesla or in the whole vehicle manufacturing world during the pandemic due to supply chain problems, which is different to inflation. I mean, we saw an increase in prices that were not necessarily related to inflation.
Right.
As such, it's a very interesting situation. And then, the Purchasing Managers Index, I was getting confused with the purple and green line.
Yes.
But this is interesting because it shows the difference between services and manufacturing, right? The Purchasing Managers Index, Purchasing Managers, manufacturing is down significantly, whereas services is up significantly. So, I mean, it just shows that the diversion of the past 30 years is just widening, if anything. And we're supposed to be trying to get back to manufacturing in the country. That's just an aside.
Again, interesting, though, Larry, to go back and look back in 2019, before the pandemic, is the divergence is almost exactly the same as it is now. So we see that the manufacturing and services were kind of trending together closer together during the pandemic and afterwards, but now it's going back to the norm. So it's not outside the norm, at least as far as we can see on this chart. I didn't go back and look at a chart going back further, but my expectation would be that this trend has been going on for a very long time.
Do you think that returning manufacturing, onshoring, and this is aside from what Cathie is talking about, but just a thought that ran through my head as we were watching this index. Do you think that the reshoring is going to have a real impact on this index over time?
So it can't just be batteries and cars. In order for it to have, and I mean, those are two big categories, but they're not big enough, I don't think, to have a major impact. It's going to have to be more onshoring than that. What I was reading yesterday, which is interesting, is that Mexico is going to they're getting a lot of the benefit of this onshoring. Their manufacturing business is going up very strongly. So companies that are coming back who are saying, I want to have it closer to home, that's where we're seeing it go to Mexico. The other thing is also dependent, I think, on the 3D revolution. If we see the 3D thing really pick up, and yes, I think we could see a lot more onshoring. I know as a manufacturer, I was watching that. I continue to watch it with intently, but the 3D thing has not happened anywhere like people expected it to.
That's true. And do you think that the Mexico situation is going to become politically unpopular, just as the China situation became politically unpopular? I mean, given the rise of populism and so on, and the sort of left-leaning, the leftward movement, general leftward trend in Central and South America?
Wow, that's interesting. Of course, South America, we saw at least one rightward trend down in Argentina.
Yeah, in Argentina.
Oh, Chile too. But anyway, I think we. So are you saying that you think that the population in Mexico will be
No, in the United States, sentiment against
Mexican immigrants.
Yeah.
Wow, that's interesting. I had not thought about that at all, Larry. That bears thinking. My first impression would be that we have a love-hate relationship with Mexico.
Yes.
And so we love to vacation there, and we love the Mexican people because they've been so integrated into our own economy. But it's like because of the crime and the all of the horrible graft that goes on down in Mexico, then we have this kind of repulsion. But I think if they get this manufacturing thing going down there, it could really help their economy, and that could maybe start to cause the population to want to have a stronger rule of law. Maybe.
Interesting. Yeah. Anyway, that's a subject for another day.
Another day.
But if you want a recession, if you want proof of a recession, let's look at new home prices. Oh, my word. New home prices are, falling through the floor. And what's driving that? Our Federal Reserve Bank.
Yeah, Larry, this is the one that shocked me the most. I was just blown away by this slide. Once again, we have to look at where it went just before all this happened, when this huge spike, but then this massive drop. Were the home builders overcharging because they could, because there was low mortgage rates and no inventory, so they could overcharge? And then did they have to just pull back? I need to look into this one in depth. As you know, I love the real estate category. I really want to find out what's really going on here. We are not seeing this drop in existing home prices. It's coming down a little bit, as it always does in the winter. So we saw a little bit of a drop in October. I'm sure we'll see another little drop in November, but this drop is crazy.
Well, because people have so if you look at the mortgage, if you look at interest rates and how they've risen, and Cathie explains this, they were historically low.
Yep.
And they went to now not historically high, but pretty damn high.
Yes.
And so what you're looking at is the largest drop in the shortest time,
Oh, yeah.
both the largest drop and the shortest time in history. Well, certainly in 60 years of history. I don't know if you go back to the 30s, if it's going to be even worse,
But more than the 68 to 70 drop.
oh yeah. Oh yeah. I mean, dramatically more. I mean, it's from
Yeah.
just under 25 to minus 18. I mean, that's 43%. That's incredible.
Yep.
Nowhere else is it anywhere near close. And people just can't sell their homes that are living on 1%, 2% mortgages, when they have to take 6 and 7 and 8% mortgages.
Right. And
that may have leveled down a little bit right now.
Yeah. Well, and on the new housing situation, the young people, I think, are in shell shock with regard to these mortgage rates and with regard to what the payments will be. And so that could be part of this. It was like you go from a 3% to an 8% mortgage. It has a dramatic impact on the monthly payment. So Absolutely. this could be a big part of it. Yeah. Anyway, we'll see. Well, I need to dig into that one, and then we'll see what happens over the next few months, because the home builders are building. They're starting to pull permits and starting to put the spade in the ground. So we'll see what happens as the supply increases.
Yeah, but if I'm right about the interest rates suddenly collapsing instead of, measured step down, blah, 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 but when they sort of wake up and Janet Yellen suddenly realizes that she may have overstepped, and the Federal Reserve Bank realizes that, they've overstepped, we could see interest rates drop, through the floor.
Right.
Then, of course, there's pent-up demand, and then, this is these waves that continue to, and this is what makes so difficult to do an economic analysis, because of this distortion, this great distortion that happened.
Yes.
So then, of course, interest rates affect what? Auto sales, and Cathie shows that auto sales are still at depressive levels. This is still at the 15% mark. And if you look at there, and there are other factors here.
15 million, the 15 million mark. Yeah.
15 million. Yeah. 15 million. But auto sales are terribly sensitive to economic circumstances and interest rates, particularly interest rates. And, again, we had, the lack of inventory. Suddenly the inventory explodes, and used car sales went up very much during the lack of inventory. Now that's collapsing. New car sales are doing quite well. They're actually not doing well at all. They're just above the 15 million, which is really, 15 million is the recession cutoff. Mm-hmm. But cars are lasting much longer, so that's also impacting it. And then the EV sales are really, very important in terms of the percentage of EV sales are rising while auto sales are at relatively depressed levels. So OEMs are outside of, Tesla, Rivian, and the, volume producers of EVs well, there aren't any others other than Tesla. But they're hurting because their numbers are falling.
Yes.
So on balance, this is a really tough market. Yep. Now, interest rates collapse. Will auto sales return? It's possible, but, will they return to Tesla instead of the others? And, Tesla doesn't have a full set of models yet. And so that's kind of those are the open questions for the coming year or two. But that's an open issue, but we are not at normal economic activity. Right. And part of that's interest rates, and part of that is this so-called rolling recession. And then, the other thing we have to look at is that we're seeing deflation because China is exporting deflation. Cathie explains to us.
Right.
And so this is the slide that talks about the China PPI year-over-year percentage change. And so if you look at, our cost of importing goods from China is falling, which makes it even more difficult to onshore. And that's having a real impact on inflation, and will have a serious impact on inflation. And, I think we don't want to spend much time on the Chinese economy at this point, but I think it's not going to be, I don't think it's getting better. I think it's actually getting worse.
Well, and China has a lot of competition now. So
Yeah.
all the other Southeastern Asian nations, Thailand and Vietnam and Cambodia, all these countries are now trying to take a bite out of what China does. As we mentioned, Mexico is now becoming a competitor to China. You're going to see some of the African nations. China's down in Africa, very, very doing a huge amount of work in Africa, trying to find low-cost labor situations where they can exploit. So the China export itself is under a lot of pressure from other countries at this point.
Yeah, and Cathie says that it's not surprising for her to hear that Walmart are expecting deflation during the next few months.
And Costco.
And Costco, yeah. And these are the people who really see it happening. And so, it's really hard to understand this, the Federal Reserve. Anyway, I should give it. Right. And so, and now we turn to commodities, because those are really drivers of, costs. And the commodity index, it's just touching the 100. I mean, the amazing thing is it never really got that high.
Right.
But Cathie's point is, if you apply inflation to this, then we're actually at a record low.
Right.
Other than the pandemic period.
Because this is not inflation adjusted.
That's the point.
If you go back and compare it to 1970 and you take an inflation, you just take into consideration from 1970 to now, we have roughly the value of the dollar is roughly 1/10 of what it was in 1970. So all of a sudden you would be below these numbers in terms of a comparison.
Absolutely.
So that's great productivity on the one hand.
Yes.
It means competition, of course, from China and elsewhere in terms of providing these commodities, but it's a real indication of wealth, it's world wealth that's been improved over that time by a massive amount.
And think about this. The population has grown in the world by a massive amount as well.
Huge.
And people keep saying that the world can't support, 9 billion people. And Elon tells us the world can support 20 billion people. And he's right, because if the world couldn't support, 9 billion people, you would have expected commodities to go through the roof. But even at nominal prices, the price of commodities today are exactly where they were in 1980.
It's crazy.
Exactly where they were in 1980.
Yeah. So I've been predicting, Larry, the last week. I've made a couple of my programs turned on this, is that commodity prices are going to be flat for a while. I don't think they'll go lower, but I think they're going to be flat for a while because there's plenty of stuff. And I think maybe they'll start to pick up in the second half of the year. But right now, I'm thinking there's no place for them to go. It's going to be flat. That's my theory.
I don't think you're wrong, actually. I mean, this spike of commodities, post-pandemic or during the pandemic or post-pandemic, to me was not real.
No.
And that's so baked into the inflation that the Federal Reserve thought they saw. I mean, they were watching phantoms, real phantoms.
Now I look at this chart. I look at this chart though, Larry.
Yeah.
And you could imagine it going lower.
Oh, yes.
As early, just in 2020, 2019, 2020, it was a lot lower. So yeah, it could go lower. I guess I'm gonna revise my thinking. I don't think it can go up, but it could go lower.
It could go significantly lower because in 1985 it was below 75.
Right.
And that was a good, we were going through this boom, and then in the 2000s we had these very big booms, and inflation since, well, is not inflation adjusted. So I think we're going to be below the 90 mark. I think you're right.
Yep.
And so we can look at oil. Cathie takes us to look at oil. And oil is really, really, really struggling. I mean, really struggling.
Yep. And there's a big argument right now as to what Saudis might do next. Some people think, was it you that said this the other day? Might have been even been you that said it the other day, the Saudis might do the old pump method, where they would actually pump more oil into the system in order to crush the market, so that the shale folks and the deep water people couldn't afford to pump. And then they would turn around and cut it off again and try to drive the prices back into the 90s. I don't think that's going to happen.
Wasn't me, and I doubt it very strongly.
They did it once and it worked, but I don't think they'll do it again. And the other side of it would be that they would continue to cut. I think they've cut as much as they can cut without messing up their budget. And I think they're not going to be able to get those African nations to cut. And so I think they're done. I think we're going to be in the 60s and 70s. That's, I just, reverting to the mean, so to speak. One of the things that Cathie didn't mention in terms of the impact on oil prices right now is natural gas. Natural gas prices are super low because of what Europe did a year ago due to the Russia problem. Europe just went crazy on natural gas. Whatever they could do in terms of creating it and or finding ways to import it from the United States. And so the natural gas prices have dropped like a rock. Well, natural gas and oil compete. They have a lot of the same customers. And so if people move to natural gas because it's cheap, that's going to hurt the total oil consumption.
Right. And, I would hedge that a little bit. Natural gas is weather related.
Yeah.
Get a really cold winter in Europe,
mm-hmm.
Natural gas prices will spike through the roof.
Right. But the Europeans have tons on hand. They're at 95%. They're filled up.
Yeah, but 100% doesn't cover a
bad winter. Yeah, right. But you also have the, the competition in plastics too, Larry. So you can, most plastics can be made with a natural gas base or a petroleum base. Yes. And so you have a lot of, I used to do that. I used to switch off on my plastics purchases based on what the price of natural gas was.
Right. I think that's a fair assumption. Look, oil is a very large percentage of the total cost structure of the economy.
Right.
And they had a lot to do about, the so-called inflation as we see.
Oh, yes.
So, I would suspect that you're right. I think we're going to see oil lower or moderate.
Mm-hmm.
But I don't think it's a big risk. Now, the United States still has to, fill up the strategic reserve again. So that is a little bit of a flaw under U.S. oil pricing.
Mm-hmm.
But, I think we'll see. Now, Cathie did mention the Kondratiev wave. I don't know if you're familiar with it. I'm not that familiar.
I had never heard of it before. Yeah.
Yeah, and that's the theory that there's this rolling wave in commodities, and that we're in this so-called sixth wave right now. Where these waves of moves in commodities based upon the change in technologies. I'm not familiar with it that much.
Yeah.
I think maybe what we can do is have a separate session on it. I don't want to spend any time on it.
Yeah.
And so I just thought I'd show it. That she mentioned it, I went off to look for it, and I'm not that familiar with it, so we'll pass it by, but it's maybe worth a deep dive into it. All right, and then the dollar. So the dollar is very interesting because at the end of the day, it is the linchpin around which prices move, right?
Mm-hmm.
So much of our stuff is imported. Hopefully we'll reshore it, but so much of our stuff is imported that, you know, the higher the dollar, the lower the cost of our stuff. The lower the dollar, the higher the cost of our stuff that we bring in. But the dollar underpins most commodities. All commodities are priced in dollars. So the higher the dollar, the lower commodity prices, right?
Mm-hmm.
And so the dollar, you know, it's holding its strength very well right now. And so for the moment, you know, that is an anti-inflationary function, right?
Yes. Yes.
And I don't see the dollar rolling over at this point. I see it continuing in this vein, right? Do you agree?
So one of the big things that drives the dollar, of course, is the worldwide bond markets and the worldwide decisions by the other central banks as to what they're going to charge for their treasuries.
Exactly.
Because there's a fungibility of dollars worldwide in terms of where people are putting their money into a savings, if you will, so there will probably, as if inflation comes down worldwide, which European inflation is dropping rapidly and China is in deflation, you can start to see these central banks, Japanese banks, same thing. You can start to see these central banks lowering their treasuries and the bond markets in those countries dropping. So there could be a flight of capital into those markets. But then it depends on what Janet and the Fed do in response. So, you know, there's always that question in terms of the value of the dollar based on all that chasing of good interest rates.
Right. Now, yeah, I messed up the next slide. I don't have the next slide. I see I repeated this slide twice. And her next slide the next thing she talked about was the metals to gold ratio.
Oh, yeah.
Metals and gold ratio versus the US 10-year Treasury. And what she said is that the purchasing power of gold in terms of metals have gone up dramatically. And so it normally associated with prices falling. And yet what did the 10-year Treasury yield do? It was going up because the Fed said we have a big inflation problem. And so Cathie's pointing out that, again, you know, this is a contraindication to where we went to with the interest rates.
Yes.
So I missed it. Oh no, I actually see I did. So this is the dollar to gold ratio, and there we are. You know, it's I mean, it spiked through the roof, right?
Yes.
And that's the pandemic, and this is, you know, we're at, you know, at sort of the 2016 levels and so on. So like all indications, this whole inflation scare indicates that we didn't have
a permanent problem. Yes,
a permanent problem, and what the Fed has done may be doing damage.
Right.
I think that's the bottom line, and so I think it's important. And then finally, Cathie shows us the performance of various of various investments. You know, what did well, what did badly, and what do you think did best of all?
Bitcoin.
Your favorite investment.
My favorite investment.
The Bitcoin outshone every other
yeah.
investment medium in the last year.
And actually, her ETFs did extremely well in the last month.
Right. Well, yeah, they did. But all innovation did well at the end of the year. And because, I mean, clearly innovation is the solution to, a lot of problems, particularly has particularly powered US growth, since the 2000s. And we continue to see it, it powering that growth. Now, Cathie remains very bullish on Bitcoin, as she remains extremely bullish on innovation.
Right.
Now, I have this view that Bitcoin is legitimate. It's a good investment vehicle. I think over time it'll do as well as gold. I think gold and Bitcoin, are alike. I mean, gold has had a terrible, 20-year run. But I think, and I don't see a great future for it. I think Bitcoin is going to assume that future. I think Bitcoin is going to be, the 19th century. It's going to be what gold was in the 19th century.
Right. So, Larry, having looked at all of this Cathie Wood analysis, and I thought she did a great job as always, how do we think this impacts Tesla? You a couple of days ago visited with I'm Brighter with Herbert. You were on the Brighter with Herbert show, and you put your number out there at 2.4 million units for next year. I tried to back into that number this morning, and so you figured 100,000. I was going to just be a little conservative and say 75,000 Cybertrucks, which I think is a little more conservative, but it could be 100,000. And then I think we are going to be about 950,000 units of, wait, 950,000 from Shanghai this year.
Oh, this year. Oh,
this year. And I think we will hit 1.1 because I think the capacity will be over 1.1 next year. Oh, no.
It's going to be closer to 1.2.
1.2 actual production or capacity?
Actual production.
Actual production. So capacity would be more like 1.3.
Yeah, I think that they are just hitting their stride in terms of production, and I think we will see them improve production quite dramatically next year as they get into those long production cycle. I mean, I don't think we will see interruption to production next year unless there's a demand problem. So I think they have a real shot at 1.2 million.
Okay, so then that would, if we,
we're getting to the 90,000, point per month at this point.
Right.
So that would only be like a 10% expansion in terms of productivity.
Right. All right. So that would leave about 275,000 that would be necessary under your analysis. About 275 that would be split between Berlin and United States in terms of Model 3 and Model Y. So that's 150, 160 each. So that doesn't, or 100.
No.
130. I'm sorry.
If you allow 1.2 for China,
yes,
you're looking for a further 1.2 million of production. What are you assuming for Fremont?
I didn't. So that's my point was I was kind of backing into it. So I'm taking your 2.4 compared to 1.8. That's 600,000. I'm taking 75,000 for trucks.
Oh, you're talking about the increment. I'm sorry.
The increment. And then 75,000 for trucks. You're saying maybe 250,000 extra for Shanghai. That gives me 325. I take the 325 from 6. That leaves me 275. So 275 split between the United States 3 and Y and the Berlin Y. So 275, that seems, that's a very makeable number if you're right about Shanghai. I was thinking only 100,000 less in Shanghai, which would mean 375 between the US and Shanghai. Do you think that's a makeable number? Increase.
Between the US and Europe.
I'm sorry, and Berlin.
Berlin. Yeah. Look, it's a stretch.
Yeah,
it's
okay.
A stretch.
Stretch goal.
2.4 is the stretch goal. I think they're going to make it. I mean, a lot of people are skeptical that they can sell that many 3s and Ys,
right,
simply because of the pricing of the 3 and Y.
Right.
That's a legitimate concern. I think they could produce it, if things really fall into their lap. I do think they'll do 100,000. I think they're being very, very canny and cautious
on
about the Cybertruck. I think that they can hit the 100. Anyway, the 2.4 is the stretch. I'm being optimistic about it, no doubt about it. But hey, if they do 2.2, it'll be a great year.
Yes, it will. Yes, it will. So, and then what about with regard to the Cathie Wood analysis? And I think you are kind of agreeing with her that we could be looking at a couple of recessionary quarters. Will that impact that result for Tesla? Of course, it would be mostly impacting the U.S. result, although they say, of course, if the United States sneezes, the China and Europe get pneumonia. So do you
unfortunately, it may not be, it may be the other way around. If China sneezes,
I see.
Today, those are troubling problems. Those are troubling problems, and they could well impact it. I mean, I think it would be as well to couch the projection for next year and saying all other things being equal, i.e. the economy continuing to be sustained. I mean, if the Federal Reserve chairman would get off his worry chair and replace the current interest rates, halve the current interest rates, then I think we're in we can enter a golden period.
Right.
If he reduces by a quarter point in April, then I think we're in trouble.
Yeah.
And I think my projection is really in serious trouble. So
now, just for fun, what do you think, Larry, if he doesn't go a quarter point until April, but he stops selling bonds in January?
Yeah, I think the two really are. I think that we have to see both. We have to see him be operational on both fronts. I think he has to moderate the sale of his stock of bonds. What you're talking about is his existing stock of bonds. That
he's still selling at this point.
Right,
which
means and that's what you're referring to. Yeah. You're not talking about new issuance.
No, I'm talking about stop selling his existing inventory. Yeah.
Right. Yeah. So, yeah, I think that's very important, and I'm not sure it's that easy for him to do, but yeah, I think that's very important. So, all other things being equal, not all other things, if the United States adopts a sensible policy, if Janet Yellen will stop taking her victory laps, I think we could have a fantastic year for Tesla. If not, how bad can it be? 2.1, 2.2, it's definitely above a 2 handle. How far above a 2 handle depends upon, things going really well. And I think we should start looking, instead of at gross margins on cars, I think we should look at the operating margin on the company. And I think that's important because the company's growing revenue so rapidly, top line.
Yes.
Not only in vehicles, but more importantly in energy. We're going to see energy. If Bradford's correct, and I believe him, we're going to see energy triple during the course of
next
year. So I think those are very important considerations, and of course, FSD.
Absolutely. Well, Larry, as always, thank you for joining me on the first Saturday of the month. Well, actually, this month it was a little weird, but the day after Cathie Wood's report, and taking a long look at what she had to say. And I think it was a very interesting report. I appreciate that you have added your analysis to it. We will see you again, if not before, but probably not before. We'll see you on Monday night on Good News Monday, as always. And we'll be looking forward to, if you have any more of those brainstorms like that amazing video that we did last week on, I think on Thursday, was the #1 video ever on this channel on the 48-volt system. And anybody out there that hasn't seen it yet, you should absolutely go back and check that out. I'll put the card up yet again right here. So Larry, yeah, thanks for being here.
Thanks a million, Randy. Take care and, have a great week.
You as well. And to all of you out there, it's been great talking to you.